Welcome to your regular market and investing program, the DLM Market Hall. This week, the Monetary Policy Committee, MPC, of Nigeria will be meeting to once again take vital decisions on the monetary direction of Nigeria. This will form the discourse for today's program. With me is Mr. Tola Odukoya, Vice President Investment Research, Don Lauren Merrifield. It's great to have you, Mr. Tola Odukoya.
Thank you very much.
The Monetary Policy Committee has been meeting, and of course, their decisions always have great impact on the economy. And first, I would like us to look at the impact of their decisions so far this year. We're in the 11th month, and of course, Nigeria's economy has been said to be in growth level. Would you say, would you agree that the MPC this year has been able, through their policies, to enable growth and also create the drivers for economic empowerment?
I don't share that opinion. The latest numbers coming out of the National Bureau of Statistics for Q3 2013 point at the Nigerian economy growth at about average of 6.5% over the last 3 quarters. That's Q1, Q2, and Q3. In my view, I don't think a country like Nigeria has any business growing at 6% levels, single-digit levels at all. And my reasons are quite open and clear. We have a
So should you consider relatively to other countries, even like some developed economies, wouldn't you say Nigeria has really to level tried?
Well, if you have the second largest economy in the world, that's China.
Yes.
Growing at about 8%, regardless of all the global financial turmoil and economic slowdown. Nigeria, which is a frontier market with more headroom for growth, has no business growing at single-digit levels. And I will tell you why. It's a nation of about 155, 160 million people, a median population of about 19, which means we have a very young and growing population, full of resources, full of enterprising people. Therefore, I don't think we have any business growing at single-digit levels, especially in light of what you mentioned, where more developed economies are actually in turmoil as we speak. Now, slowly coming out of it. Meanwhile, we're growing at 6% levels. I don't think we should be growing at 6%. Well, it's good to the extent that if you compare it to other economies, like you rightly said, well, maybe, but I think the last couple of years or last 3 years has presented a fantastic opportunity for a country, an economy like Nigeria, to really outpace other frontier markets and maybe some emerging markets in terms of growth. And you can never overestimate or overemphasize the importance of monetary policies in stimulating growth. Also, we've seen instances where the central bank has complained that banks are not really lending to the real sector, hence the creation of several intervention funds. However, we have always shared the belief that the problem with Nigeria, really, especially inflation, is really not a monetary phenomenon. It's more of structural issues. And I'll give you an example. Regardless of the fact that the benchmark rate NPR was raised aggressively, which ended in Q4 2011, you saw inflation very high last year, actually averaged 12.3 in 2012. Regardless of the fact that NPR was moved aggressively, rates went up aggressively. However, if you look at the fact that in Q1 2012, when there was a partial removal on the price of PMS, on petrol, that contributed largely to the spike in inflation in 2012, rather than the increase in monetary policy. Because remember, the increase in monetary policy started late in 2010 and ended in the Q4 2011. Regardless of that, inflation was on the uptrend until we saw that increase in PMS last year, which now drove inflation to almost 13% last year. Now, yes, to an extent, you may want to argue that the monetary policies have contributed to the moderation of inflation so far this year, which is why we've remained at single-digit levels and going down this year. However, you also will agree with me that most of what we're talking about in moderation in inflation rate now is based on base effects. And when I talk about base effects, I'm talking about the fact that from 2012, where we had high consumer price index levels compared to the relatively slower levels we've seen in 2011, 2013 now, we could say arguably monetary policies have contributed to the moderation in inflation. However, remember, as a result of the increase in PMS last year, that really contributed significantly to constraints in income for the average household, to the average household income. And so to that extent, that would then generally deflate prices. So hence the argument that, well, you may want to argue that monetary policy has contributed to reduction in inflation, but it's not solely responsible for that. There are other structural issues, as I mentioned earlier, that actually drive inflation in Nigeria and not necessarily monetary issues. Because if you check it out, how many people in the 160 million people, right, in Nigeria actually have access to credit or are linked to the yield curve, as it were?
That's
actually borrow.
Inclusion.
Exactly. So those are things one needs to really assess and analyze very well before we can start talking about monetary policies really affecting the broad economy, as it were.
There's been so much talk about the structural, okay, in terms of it's good to moderate inflation, but the issues of structural approach to the economy. What comes to my mind is the Abenomics, in Japan, the complete bringing together the monetary, fiscal, and structural approach. Now, in Nigeria's case, what do you think the embassy can really do in terms of the monetary aspect? Is it just about moderating inflation? What are the structural issues that could be?
Well, my own view about this has always been, I would love for us to have a minimum of 5 to 10 year view on inflation, exchange rate, and growth in the domestic economy.
Has there been a view so far, or has there been over the years?
Well, I haven't seen that. The closest I've seen to that was under the previous governor, where regardless of the fact that inflation, NPR was at 6%, we saw a very strong growth within the economy.
That's Professor Soludo.
Yes. Now, there are different schools of thought in economics. Those who believe that you need to fight inflation and stabilize your currency, which is okay, depending on your school of thought. And there's also the school of thought that believes that you need to stimulate economic growth by allowing credit to flow through the economy, which is what we've seen in the quantitative easing in the US and the UK and some parts of Europe. So there are various schools of thought. However, my strong view has always been that for a country like an economy, I always tell people that the Nigerian economy, I think, is built like a Porsche, the car, very powerful engine. And you cannot afford to be driving it like another lower grade brand. It's an economy that should be driving at very strong pace. Why? The statistics I gave earlier, a nation of 100 plus million people, a median age of 19. If you look at the analysis of pension fund contributors, right, about 50-55% of contributors in pension funds in this country lie between the age of 22 and 35 or 40.
Which is very
exactly. So that tells you that you have a very young population that's willing to contribute to economic growth. So what you should be concentrating on really for an economy like Nigeria is economic growth, creating employment, stimulating growth, right? Rather than fixation on inflation, because there's always that trade-off between inflation and growth. In the short term, yes, when you allow credit to flow to the economy, yes, you would have inflation in the short term. However, because you deflated the cost of the factors of production, in this instance capital, right, to single-digit levels for us in Nigeria, you now create jobs, you create increase in domestic output, you improve your GDP, right, your output within the economy, and overall, the broad economies. And over time, we've seen these examples, like I mentioned the other day, in China, in Brazil, in Russia, especially China. I actually did a study in China, where interest rates were deliberately kept quite low. And during that period, there was an initial period where inflation was quite high within the economy. However, over time, inflation dropped significantly over time. They have similar characteristics to Nigeria, large population, relatively young also. And so they looked inwards and started looking at creating domestic production, employing, engaging the young population, so that overall at the end of the day you have a vibrant, and everybody will be better off for it. So that's my strong view about inflation, exchange rate, and economic growth.
Ahead of this week, what do we expect? Do we expect the MPC decision to begin to tilt towards that direction?
Well, I don't think there are any prizes for what the outcome of the MPC meeting, which is starting today, Monday, will end tomorrow, Tuesday. I don't think there are any prizes to what will happen or what the outcome of that meeting is. The body language from the central bank has been that the central bank hasn't been too pleased with the elevated system liquidity so far in recent months, regardless of the increase in cash reserve ratio on public sector funds. So
why is it like that? Because normally it should have a kind of
well, don't forget that there are other in recent months, since 2012, for example, securities have been issued by the central bank through the open market operations, the OMO auctions, and treasury bills auctions. And you also have other bonds maturing also. So you have OMO bills maturing, you have treasury bills maturing, and some federal government bond maturing, which will put liquidity back into the system. And as a result, liquidity is always within the system. So regardless of the 50% increase in cash reserve ratio, you have liquidity still within the system. So like I said, my expectation for this for the meeting holding this today and tomorrow would be most likely the NPR will be retained at 12%. I suspect, or rather I would not be surprised if the cash reserve ratio on public sector deposits is increased beyond 50%, or if the normal cash reserve ratio on non-public sector funds is also increased upward from the current 12%. Why? We know that in December, AMCON bonds will mature, and there's an early call also on some AMCON bonds. That's going to put about 1.7 trillion naira into the banking system. And I know, given that the fact that the authorities that are prevailing, the monetary authorities have made it clear that they will not condone any sort of elevated system liquidity, we know they're going to take that out. So, and to compound that is the fact that AMCON has given bondholders the option to either have the securities redeemed in cash or in treasury bills. So we have potentially about 1.7 trillion naira in cash coming to the system. Well, some bondholders might opt for treasury bills, some might opt for cash, but however it comes into the system, I'm quite sure that the central bank will pull one or two monetary levers to take that liquidity out of the system in line with its policy drive over the last 2-3 years.
It has been a wonderful time today discussing about the Monetary Policy Committee decision and its policies and how it affects the economy. Keep with it next Tuesday on a wonderful February program on Market and Investing, DLM Market Talk.